Picture the last 6 months of your trading as a single line on a chart. Now picture the line you would actually draw from memory. Climbing, mostly green, a couple of rough patches you have already explained away. Here is the uncomfortable part. The track record you remember and the one that actually happened are two different lines, and the gap between them is the exact reason you keep making the same mistake. If you journal every single trade and you still repeat the same mistakes, this is why, and almost nobody in trading will tell you. The record you learn from is partly fiction. Start with how memory actually works, because it is not what you think. Your memory is not a recording. There is no clean video of that trade sitting in your head that you play back. Every time you remember it, your brain rebuilds it from a few fragments and quietly fills the gaps with assumptions about what probably happened. And those gaps are easy to bend. In a classic experiment, people watched the same car crash, then got asked one question about it. Some were asked how fast the cars were going when they smashed into each other, others when they hit. One word. The smashed group recalled faster speeds, and a week later, many of them falsely remembered broken glass that was never in the footage. Same event, different word, a different memory, built on demand. Now here is how that bends for traders specifically, and it bends in one direction. You remember your wins clearly. Your losses get quietly rounded off. The winners get sharper and a little bigger. The losers get fuzzier, smaller, basically break even. And this is not just a feeling. When researchers surveyed real mutual fund investors about their own returns, people remembered earning more than they did, and the bias was worse for the funds they had personally chosen. The more your ego is on the line, the kinder the memory. Here is the part that should actually worry you, because it is the spine of the whole problem. That same line of research found the bias is not harmless. The more your memory inflates your past performance, the more confident you get about the next trade. Biased recall does not just distort the past, it directly feeds the overconfidence you carry into your next position. And it gets more specific. Take hindsight. Before a trade, you were genuinely 50-50. You took it, but you were not sure. Then it wins. And after it wins, you remember the setup as obvious. I knew that one was clean. Your memory quietly rewrites your past conviction to match the outcome, which means you can no longer honestly grade a decision you do not remember correctly. Then there is how you score a whole session. You do not remember the average. You remember the most intense moment and how it ended. So a reckless day that dipped into a deep drawdown but happened to close green gets filed as a good day, and the 2 hours of white-knuckle damage in the middle simply evaporate. Now line it all up, because here is where it becomes a machine. Your journal is built on a flattering edit, so you pull the wrong lesson out of it. That wrong lesson makes you more confident, so you size up, and you repeat the exact same mistake. Then, write it down wrong again. The loop that should fix you is the loop breaking you, and it spins a little faster every time. So here is the pivot, and if this is landing, subscribe, because I break down one trap like this every week. You cannot fix what you cannot accurately remember, which means the answer is not to try to remember harder, it is to stop trusting memory at all and start reviewing from records that cannot flatter you. 5 ways to do that, all free, all today. 1. Write the trade thesis before entry with a timestamp. Why you are in, where you are wrong, where you take profit. Afterward, you compare what happened to the note you already wrote. You kept the receipt, so hindsight has nothing left to rewrite. 2. When you review from your broker's exported trade data, not from memory. Your fills, your sizes, your times, the boring CSV that nobody opens. It is free, you already have it, and it does not care how you felt. 3. Separate the decision from the outcome. Grade every trade on one question. Was this a valid setup by my rules at the time? Yes or no? A good decision can still lose, and a reckless one can still win. If you only grade wins and losses, you train yourself to repeat lucky garbage and punish your best trades. 4. Score the process with a per-trade checklist, not by how the day felt. Did I follow my entry? Was my size right? Was my stop set before I got in? Was I inside my plan? Ticking boxes is immune to peak end. It cannot be charmed by a green close. And 5. Trust the aggregate, not the anecdote. The trap is the one vivid story your memory keeps replaying. The revenge trade, the hero exit, when that is just a single dot out at the tail. Your real edge is the whole pile of trades, not the one highlight your memory saved. Notice what every one of those has in common. Each one works today with free broker data and a sticky note. No app, no subscription, nothing to buy. If you do nothing else this week, do those 5. The only genuinely hard part is doing it consistently, in real time, in the exact moment you are tilted, which is the reason we built Meridian to capture that objective record automatically, time-stamping your decisions and your risk as they happen, so the receipt writes itself. But I will say it plainly, the 5 free methods work without it. Meridian just automates the part you will skip, precisely when it matters most. One of these every week. A real mechanism behind a trading problem, taken apart. The free playbook is in the description, and if you want that objective record automated, the tool is at meridianpsi.com. Now go and check. Is the track record you remember really the one that actually happened?